She's here. Oh, there. It's this lady here. Hi, Miranda. Hi.
Am I? Yeah, all right.
Yes, they're going to mic you up in a minute. Don't worry. Although there wasn't one on your seat, was there? Did you have one on your seat?
I'm sure I would do.
No, you'd have felt it.
I know. I mean, if I didn't, then we have a bigger problem.
We'll
A
get you
different
in
problem. Sorry, whatever what he said. Yeah.
There isn't a mic here.
I know. I could, but anyway, self-control is
There's no mic. There isn't a mic here. So the panel's for 45 minutes. Do you want to take questions? Yeah, so I'll give you like 10 minutes in to the end. Yeah, okay. I'll make a signal, whatever that might be. I'll be sitting here. So good afternoon, everybody. Welcome to this next panel session entitled Investor Perspectives on African Private Capital Markets. It's 45 minutes long, so I want to make sure that all of the panelists have a chance to speak and contribute. I'm delighted that our moderator is Miranda Abraham, co-head of loan syndications from Rand Merchant Bank. My name is Veronica Bolton-Smith. I'm the team leader for Ghana Jobs for Economic Transformation at Palladium, an FCDO-funded program. Been in trade and investment for 19 years, specifically on Africa, and really glad to welcome you all here today. So I'll now hand over to Miranda to take the panel forward. Thank you.
I'm Miranda Abraham from Rand Merchant Bank, as you've heard, part of the Loan Capital Market Solutions team, co-head of the loan syndications team there. So delighted to be here today moderating this panel on investor perspectives on private, African private capital markets. And I'm going to start by introducing our fabulous panel that we have here, distinguished speakers. So without further ado, we'll just get the ball rolling. And Michael, if I can ask you to start with your introduction, please. Thank you.
Miranda, thank you. Good afternoon. My name is Michael Parketney. I'm working for Bank Trust. We are an emerging markets-focused investment bank, and I run the debt capital markets for the bank.
Thank you. And Ido?
Hi, everyone. My name is Ido Soum. I'm a partner at Steelcom Capital, one of 5 partners. We're managing one of Africa's largest and first VCs, and we invest in everything tech-enabled, early to growth across the continent.
Hi, my name is Rui Oliveira. I run the asset management company, the largest in Angola. We essentially we fund, we manage mutual funds business in the fixed income space, and we're now moving into the alternative space as well.
Hi, I'm Alex Wane. I'm the CEO of the Global Innovation Fund, an impact-first investment vehicle that's backed by major bilateral aid agencies doing debt and early-stage debt and equity investing in sub-Saharan Africa and South Asia.
Hi, I'm Andy Bainbridge. I'm a partner at Gateway, which is a specialist asset manager focusing upon the emerging markets of South and Southeast Asia, Africa and the Middle East. And I'm also the chair of the Private Infrastructure Development Group, which does pro-poor infrastructure across Africa and Asia.
My name is Victor Bosta. I'm the co-head of DI Magister. We help African companies raise larger international financing rounds and do M&A.
Thanks all. So we're going to start by talking a little bit about the interplay between public and private markets. And just get straight into the question of, in this current macroeconomic environment where we see all these headwinds and challenges facing us, talk of global recessions coming, is that a market in which we think there is more opportunity for private capital markets as opposed to public markets, as we're seeing that bond issuance is obviously massively down in Africa? And does this create an environment where actually it's better to go and do your issuance on the private side? So if I can direct that question to Michael, first of all.
Thank you. So in my job, I deal with institutional investors who invest in debt, both on the public and on the private side of frontier markets. And I must say that obviously, since the beginning of the year, the outlook for private debt has been challenging. And it is really related to three key aspects. One is, in a majority of institutional investors that I speak to, the illiquid portion of their fund, which is obviously the private debt, is a percentage of overall portfolio. So if the value of overall portfolio comes down, as it has over the last 9 months, where the cash prices of bonds have fallen, for instance, to 70% or 60% or even lower, then obviously the portion of the private debt available for investments is shrinking as well. So actually they have less money to invest. The second issue that I have encountered when talking to them is inability to price new transactions, especially on the private side. So obviously the market in the public market has been very challenging. It's been difficult for investors to price deals. The volatility is very high, the outlook is uncertain, and the public market has not been functioning properly. And it makes it even more difficult to price new transactions in the private space. So that's sort of the second reason. The third one is the famous illiquidity premium, which unfortunately during the times of uncertainty goes up. And when the market is stable, then this illiquidity premium falls. When the market is unstable, it goes up. So when you look at those factors and some others, it really creates a very challenging environment for private debt, especially in sort of EM frontier space, which Africa is. So that's sort of my outlook. So maybe a few words about sort of my perception of how it is going to unfold. We obviously need to wait until Fed sort of stops raising rates and we have some certainty of where the normalized rate is going to be. And then obviously as a result we'll have more stability in the public market, and it will then sort of transform into willingness to invest in private debt.
Thank you, Michael. Victor, any comments to add on this?
Well, so money costs more now than it did a year or two ago across every category. So there are a couple of observations, because we work with companies typically in Africa that are growing 20, 30, 50, 100% a year. And we're always on the side of the company in terms of helping them raise money. So I guess a couple of observations. First, it's already come to Africa. So, I mean, there's, is it going to come in what shape or form? It's already here. The stats don't show it yet because there's a delay in, the rounds typically take longer, et cetera, but it's already come. So a couple of observations. First, those companies that actually can raise money one way or another in this environment, you really are then in a very special category. Put another way, if you were in fintech in Africa 4 years ago and you raised $50 million, you were the only person on the continent that had it, and nobody else had it. Last year, you had to raise $50 million just to be in the game. So what we have today is that there's large number of companies in the growth space which haven't raised for some period of time, and there's going to be delay in fundraising. So those companies that can put together 20 million, 25 million instead of 50 million find that they can compete in a different way now than they would have been able to do a year or two ago. Not only does money cost more, but it's more valuable to have on the ground. I guess that's the first point. The second point is that Africa is probably the last place where people can find billion-dollar markets that are pretty much uncontested. You know, I mean, whatever you look at the stats, they're uncontested for a reason. I mean, it's hard to do, and it takes a long time, and a number of other panels have talked about it, but there's almost nowhere else on earth you can find multiple billion-dollar markets that are more or less uncontested. Which means that if a company is able to develop itself to a certain stage, there's a big payoff for it. Their take rates are higher, their underlying profitability is higher, degree of competition is much lower. I always use the example that if you started a business in China and it was working, within a week you'd have 40 competitors. Right? In Africa, it'll take years for anybody to show up to be a reasonable competitor, even still to this day. So my point is, yes, money's more expensive. Yes, it's come to the continent, but those companies can put together even smaller financing rounds now. That money is worth multiples of what it was worth a year or two ago in terms of their relative competitiveness. That's certainly what we're seeing.
Thank you. And then wanted to move on to the topic of volatility and the interplay that we see there between less liquid instruments in the private capital markets. Andy, do you have any comments about how liquid are these products really, or illiquid?
Well, I think my observation would be that we tend to fool ourselves when instruments are listed in many of the markets across the continent. We think because they're listed, they're liquid. They're not. All you've got is a bit of price discovery, frankly. But the markets in too many of our countries across the continent are very thin. So I think the real challenge for all of us is in those countries where you have significant pools of capital which are built up through pension funds or insurance companies, how do you mobilize them into the private sector? And I think that's a place where people like DFIs can help to play, where the use of guarantees certainly can help to mobilize. But at the moment, I think when we talk about public and private credit, particularly in these markets, we have the illusion of liquidity rather than the illiquidity premium.
Great, thank you. And then thinking a little bit about the investor landscape, how do you see the investor landscape for private capital markets? Where is the institutional investor looking to put their money? And if I could start with Alex, please.
Well, let me actually build on this point that you were making about this interplay between DFI money and private commercial capital. I do think that we collectively, especially those who are in this sort of interesting, messy middle, like the Global Innovation Fund, need to think about how to create vehicles where you have both DFI money and private money together, with backed by a guarantee, et cetera, so that you are able to mobilize more capital, but do it in a way where private interests are protected. I think we haven't been sufficiently creative ourselves enough. We haven't set up the right rules of the game for the DFIs to take on enough risk themselves to be able to meet that moment of blending more of this capital together. So I'll put a +1 and a plea for those of us in our messy middle space to work harder on that.
Thank you. Ido, any comments to add on this topic?
I think that we're definitely seeing less, private investments are less the flavor of the day. I look from a very niche point of view, which is technology, and this is definitely a market that took a hit globally, both on public and private markets. We have seen down rounds on many private companies. We definitely had seen public multiples coming down. I think that the one comment I would make, what we saw in the last 2-3 years is a lot of foreign capital actually being the majority of the capital deployed into private companies, tech companies in Africa was foreign, not just foreign LPs, but actually foreign GPs. And that is slightly changing this year because they're all back to their cores. They're trying to fix their problems at home, let it be the US or Europe or China. What we are, I think, the interesting observation there is that we have seen at the company levels themselves actually the market was not that shaken because you are serving, on average, a very low income demand as you were before. So not much had changed on the ability of companies to grow other than their ability to raise. But the fundamentals of the demand for what they sell is pretty much the same, which is very different from what we're seeing in other markets. So to me, to investors that are able to look through that, there's actually a very interesting angle in approaching Africa now. It is unfortunate that not many have this level of granularity when they look at Africa. But I think this actually puts Africa and technology in Africa, but not just, in a very attractive place over the next couple of years that people will be able to see through that.
Ru, any comments to add?
Yeah, I mean, I would probably build up a little bit from what you said. So, we all know there's dry powder running around globally. Private credit, it's globally at least is 1.6, around 1.2 trillion. So that in of itself, I think it represents a big opportunity when it comes to asset allocation or capital allocation into EM markets, and obviously Africa also counts for it. The other points of tech-enabling markets, I think Africa has shown to be a great place to be invested on in terms of solutions that are quite innovative. So we at least as asset managers, we look into that as well. And we try to, as much as we can, to also speak to other investors, both on a global basis, but also on a regional basis as to whether or not this can be a sort of a continuation, if there's any growth into that. And we do believe that there's growth into that. There's also at least the way that we see a conversation between the public markets in a sense of high yield bond market, which is still attractive. I heard from the panel before on the conversation of institutional investors. So a lot of these institutional money goes into high yield bonds. And I guess our job and maybe the challenge is to try to sort of shift that into the private credit, which has been actually outperforming for the at least more than 10 years now, in compared to high yield bond markets. So there's definitely a growth story there that we can take advantage of.
Victor?
I'm just going to say that what Ru is saying about the pools of capital available, the dry powder, and the number is astonishing. The challenge for African companies, and maybe I can speak more about growth companies, but maybe more generally, is eligibility or qualification. The bar for qualification's gone up. We were talking before about a couple of dimensions, Alex. I'll steal one of your points only because you'll jump in, and so my plagiarism is
noted.
Anyway, plagiarism's a good thing. In any event, my point is that there are bars not just for performance, but there are bars for compliance, and which I guess encompasses governance. And I guess from your point of view, you were talking earlier about qualification for sustainability, et cetera, which all of these things, by the way, nobody cared about a year or two ago because there was more or less the same quantum of dry powder, plus or minus, but the bar for qualification was much lower, and it wasn't multidimensional. If you were in a space which was fairly open, the business was doing reasonably well, you were doing X, Y, and Z in terms of growth and performance, and you were early stage, that was enough. It's just the bar has gone up on a number of different dimensions. And so biggest challenge that African companies have in accessing these trillions of dollars of dry powder, which is waiting to be deployed, is eligibility. And probably 70 to 80% of the companies that we deal with on a regular basis don't yet fully grasp where that bar is across the different dimensions. The reason is the ecosystem and the growth stage is a few years old. This is the first time everybody's had to deal with it. And we see experienced investors, like some here, definitely pushing companies to be, and CEOs to be more aware, but it's a learning curve.
Yeah. So maybe I would only add to that and sort of connect it with the DFI involvement, that I, for instance, see DFIs in this challenging time as really a catalyst of those changes, either through equity investments or hybrid or debt investments, and they could really sort of drive those companies they invest in terms of governance and in terms of, sort of improvement of all the elements within the company's functioning, so that they get to the level of eligibility that you mentioned about. So I see DFIs as sort of a critical, having a critical role here in the process.
Yeah, I think that what the example that we were talking about earlier was that GIF has invested in a company in East Africa that's doing sort of ethical plastics recycling. And so, of course, there's a ton of safeguarding issues that go around that because of how waste picking and recycling works. And really, we were one of their first institutional investors, and our primary offering to this company has been to strengthen their safeguarding, their governance, their responsiveness with regulators, and their dynamic with regulators, where you can actually see these companies pushing regulators too to think about how to up their game. And this has resulted in corporate money coming into this company in their next raise. And I think this is an example that we're going to increasingly see again, and I'm sure you have experience like this as well with companies in your portfolio, where you're thinking about getting them ready for their next round of money means upping their game on some of these particular topics.
Can I also just jump a little bit? So we're all just sort of talking about from a company perspective, but Africa is a huge place, right? And reality is, at least from my point of view, is that a lot of the sort of usual suspects when we think about Africa are Kenya, Nigeria. But then when you speak about other countries, there's still that sort of mystical place, and one of those is actually where I'm based, which is Angola, and it's quite interesting because we come to places like this, and we speak about Angola, and there's always that sort of they frown their eyes a bit. Oh, Angola, yeah, all I know is oil, but that's about it. But there's actually. That is to say that there's still places that haven't really been tapped into, whether from a PE perspective, but also from a DFI perspective.
A venture perspective, yeah.
And a venture perspective for sure. There's ecosystems to be built. Angola, for example, is a nascent market. We're currently just sort of in the beginning of everything. We're starting out with angel investors, with incubators, which our central bank is actually the one that is pushing for that. But it would be really interesting to sort of see, sort of DFIs really coming in and try to see, what kind of deals that can be made. So there's also a story to be told on untapped potential into the continent for sure.
Well, let me but I'll just one thing very, very briefly. But it will please you that whenever I talk to institutional investors and I ask them to rank the top 3 countries they would invest in Africa, actually recently, Angola has been always number 1.
Oh, wow. So we should talk. I'm in the right place.
Yeah, well, let me just build on your point, Ria.
Sure.
So going over to the other side of the continent, I'm involved with a company in Seychelles that was the subject to the first LBO in the country 3 months before the pandemic hit, which was classically bad timing. And we listed the company 2 weeks ago in the Seychelles. And one of the things we found is working with the authorities there to get the regulations right, to get the notifications right, professionalizing the company so that we can deal with investors and give them the right level of disclosure. And we've done a lot of that because we think it makes our company better, but it also makes the environment better. And it's starting very slowly to mobilize local capital into local markets. So the next stage is we're doing a bond. But we actually had a DFI that supported us in the LBO and has supported us since then. And they've been incredibly pragmatic. They've said, here's what you need to do to professionalize, here's how you raise standards, but they haven't imposed a set of demands to theoretical, and they've been with us every step of the way. So I think there are increasing numbers of DFIs out there who recognize their job is to help markets transform.
But so I think that moves
Angola to the left and Seychelles to the right.
So I think that moves us nicely onto the world of ESG, and obviously we see a lot of activity on the continent at the moment. Any comments to make, Alex, in terms of how ESG is positioned across Africa? Where do you see the most activity?
Well, I kind of touched on that earlier in terms of thinking about the power of working with companies to, yes, professionalize and strengthen their governance and safeguarding ability, not just as an end in and of itself, but as a means to accessing additional rounds of capital. I do think it's an interesting, one point that I think is interesting for us to think about more generally in this space is rather than sort of setting technology standards for companies, tell them the outcomes you want them to achieve and to be able to do, and leave you as the investor, be a bit more agnostic about exactly what will be the standard, the technology or whatever it is that's used to achieve that outcome. There's definitely a process of self-discovery here, and it's quite unlikely that a priori you know the best answer as to what's the means to achieve that ESG end. And so I do think that there's some outcomes-oriented stances that we collectively could be taking as investors, as opposed to saying, you shall do this set of activities and that shall allow me to tick a box.
Great. And do we see the ESG widening investor pools? Is there more focus on the E? Should there be more focus on the G and the S? Can I ask perhaps Ido to give his comments on this? Thanks.
I think ESG is always an interesting one. A couple of points there. From a lettering perspective to us, from, again, the very specific niche we're looking at the market, is mostly around governance, because we hardly touch on things that have a hard impact on the environment, just the nature of the investment we make, not to say there aren't investments that should put a lot of weight on that, but for what we do, this is fairly light. And the S side is, many times sort of the softest and hardest to grasp. So governance is the driving force in a lot of what we do. I would just make one comment. While we are very much in favor of instilling a lot of this and having many DFIs on my cap table as LPs, we are very obliged and committed to reporting and so on and so forth. I would say to Alex's point that, and there was a previous point made here about the bar we're setting for African companies, or is set for African companies, I would argue that at times on this front, the bar is somewhere way higher than the global bar. And that is okay at times, but let's not forget that we're working by definition in the most constrained continent globally and the most constrained market within. Founders and entrepreneurs that are first generation, many times again on tech side and many times family businesses on other fronts that are just going through the first phase of commercializing and institutionalizing what they do, and now we also want them to be 3 light years ahead of everyone else on Earth on a little bit too many fronts at times. So I would argue that while this is extremely important, we all need to sometimes reflect as institutional investors on what is really important and what is just looks nice on the annual Chrome reports that we print at so many copies. And balance those requirements, or at least stage them in the right way.
Yeah. Are we asking too much? Yes, Victor.
The only thing I would say to that is, right now, with companies looking to raise larger amounts from international investors, there is almost an independent additional value to governance and compliance that didn't exist before. Whether it's binary in that I won't look at it unless X and Y, or it reduces the discount rate that incoming investors view, and therefore by definition increases price. So it's the first time in 5 years of working with companies on the continent that we've seen compliance, adherence, and quality governance go to price. And it's happening in real time. So that's they're held to a higher standard, and at times that feels either unwieldy or unfair or both. but it is going to price. And so it is, I think, perhaps drifting into the category of a necessary evil or an essential requirement.
There is a slight balance there, or a needed distinction there between things that are, governance is required at every good company, period, to the length that sometimes, for instance, impact measuring goes to, which is not a necessity for all companies on all fronts, or at least needs to be thought about.
Yeah.
So I would distinct those. I'm not arguing about the need for better governance.
And Andy, do you agree? Do you think it is widening the investors, or is it too harsh?
Look, I have a pretty simple view on this, and it goes back to what I said about the DFI who worked with us in Seychelles. The critical word is pragmatic. So if you can raise standards, that's absolutely the right thing to do. But I was having a conversation with a completely different DFI towards the end of last week. And they were saying, well, these are the kind of things that we would want you to measure. Can you measure them easily? We don't want to create a significant burden. And that's exactly the sort of conversation I think you want to be having with DFIs, where they are encouraging the right standards, but they're taking that sensible attitude of, you've got to help family-run companies to professionalize, you've got to help growing companies to professionalize, because professionalizing these companies gives them access, as Victor says, not just to money, but to more sources, which then, as Victor says, goes directly to price. So I think there are, I know this is a little unfair to say, I think there are good DFIs and bad DFIs, and I can name at least 2 really good ones because they're pragmatic.
We at GIF also went on some of this impact measurement journey, sort of baked into our governance that we will report on impact of the companies we invest in. And I think part of the key of how we've built our ability to be pragmatic and practical is to think about what data do you already collect anyway, and what can we do with that? And really give ourselves a higher bar about asking for additional data collection by already very stretched entrepreneurs.
I like the point of the pricing, because I think the economic side of things is where you actually get to, when you speak to companies, especially when they're family-owned, right? And which is something that you see in countries, especially in the Central Africa countries, where a lot of us are not really well sophisticated. We're still sort of, comparing to north of Africa or even South Africa, for example. So looking at companies that are based in Central Africa, in discussions with these companies, the conversation always is, look, if you sort of think about, look, you can't just be a family run, you have to be professionalized. There's this economics incentive. So it's quite sort of easy when you get to those conversations. Then the question becomes, all right, so how do I achieve that? How much do I pay for that? So what's the cost of actually getting to, achieving the economics that is needed? So and maybe this is not a theory of mine, is that's where the DFIs will have to definitely sort of think about and come in to support that the companies are really willing to do that.
And so staying with this theme of high standards, I just want to touch a bit on the concept of greenwashing. I know there's been quite a lot of backlash in Europe about some deals where there's been some accusations of greenwashing and so forth, less so on the African continent, I think. But Alex, perhaps you can give us your perspectives on this.
Well, and I think we've actually started to hear around this term impact washing. And it goes to, some of this measuring impact. Are you really going to start? You have to be careful that you're not sort of drinking your own Kool-Aid or getting high on your own supply a little bit on this stuff. And get that balance between pragmatism, but also, I think, transparency about what you are and are not able to say. I do think it's true that there are some companies for whom being able to measure and rigorously report on their social impact helps them further their business goals. So it can be truly additional for them. And that's going to be true to a greater or lesser degree. I think the key in this is transparency and being quite clear how you measure impact and how you think about that. So for the DFIs at least, there's some quite nice standards that have been set by an NGO called Publish What You Fund. And they've sort of set out there reasonable targets that they think DFIs could meet around transparency, around investment thesis, impact, et cetera. And there's no reason that other private firms couldn't be informed by these standards as well. So at GIF, we've taken on this publish what you fund metric in terms of assessing how transparent we are. And I think it will be an interesting conversation to see that sort of spread in the larger DFI community.
Thanks. Roo, any comments to add?
You know, I love my DFIs, so I have nothing I don't want to sound like I'm, for it. No, I mean, I guess the topic on transparency and the topic on being pragmatic is definitely the theme, right? I think that's eventually that's where it comes down to it, because as I said previously, and we all sort of come into that conclusion, this is still very nascent. Even in more places where the money has already been flown into, like Kenya and all very most sophisticated markets, it still is nascent. So, and when you add on the ESG factor to it, it's even more nascent. But, just to give one example, is that maybe about 2 years ago, companies wouldn't even discuss this. ESG, what is that? There's no conversation. But today, you go into at least the most sort of well-grounded, like financial institutions. There's absolutely no way where their compliance officers wouldn't know that they have to meet some type of ESG criteria. And I've had people in our parent company has come to us and asked, can you support us in getting this ESG thing off the ground? So it's for us at least. It's important. It's critical. And if we could get some support, whether from DFIs or even from other GPs that are around, to get sort of get to the next level of things, would be that's probably the goal.
Great. I'm going to move us on quickly to talk about the market, because I know that we've talked amongst ourselves, there's a bit of a gap there. So is there enough activity in the mid-market? And if I can start with Ido, please, your comments.
Again, we're tech, but I would say that there's definitely still a gigantic gap in terms of capital. We had seen a growing ecosystem at the very early, so call it pre-seed, seed stages, not to say that it's sorted, but just to say we have seen more capital coming. I think what we are seeing less of is structured local capital for larger A, B, C, so early growth rounds. This is still extremely hard to come by. We need several more larger locally based funds that are able to analyze and understand market gaps and company and business models in depth when they start growing. So betting on a great team with a good idea, we have more people now that are willing to take such bets. Local entities that are able to help them execute, support them in their growth, we see less of. And I think for foreign investors, what we are starting to see that, again, when markets are slightly down and they're less excited or less competing for deals in their own markets and then coming to ours, this is becoming more challenging for them to really understand the distinction between 10 models of fintechs in Nigeria or the 17 B2B marketplaces in Kenya, Nigeria, Egypt, Morocco, and so on and so forth. And there are very interesting differences between them, but in order to understand those, you really need to understand the nature of the market, the structure of the market, the fragmentation of the value chain. So I would definitely argue that there's a lot of space there for more capital locally.
And Antti, any comments?
Yeah, just in answer to your direct question, is there enough activity in the middle market? The answer is no, for the avoidance of doubt. I think it's a massive gap. I think one of the issues is I look as the free trade agreement takes hold across the continent, and I see the availability of finance for the multinationals at the top, and I see every country either has an SME fund or has a DFI knocking on their door to set up an SME fund. What I don't see is that growth capital in the middle market. I think that's the kind of death valley between everyone's going to be an entrepreneur and a big multinational. You've actually got successful companies struggling to access the money to grow. And not everyone's going to be an entrepreneur. Some people just want to be able to feed their families, and we have to be able to provide the jobs that do that.
Thank you.
I think also just to comment, if you telescope it down today, it's private capital equity, just to make sure we're clear. It's easier to raise 40 or 50 million than it is to raise 20 million. And it's harder to raise 20 million than it is to raise, 0 to 5.
Sure.
What you find, we did this exercise, up to about 10 million, there's quite a lot of people who do these sorts of rounds. You go to a Death Valley, which is around 20 million round size, and then at 40 or 50, when I say it's easier, of course not everybody can do it, but the companies that aim to do it, that qualify to do it, find a degree of receptivity for that kind of capital that was plentiful, will be plentiful again, is a little trickier to get today. Fair enough. So actually, if people like TLCom raised a growth fund, and other people who were operating in the market raised rather than a pure VC fund or an addition, right? If there was growth money that people could lead $20, $25 million equity rounds so that companies can bridge to a point where they become multinational, break even or profitable, et cetera, et cetera, et cetera. But that air pocket around 20, 25 million has been perennially the hardest to fill, never got filled, and never actually was populated by enough funds willing to do it. Tickets are too small for international investors, because it's like, why would I do all this work in an odd place like Africa to put $10 million and lead a round? I'd rather put 30 or 0. And too big for quite a lot of pools of local money. And there's a very small number of people willing to do it. That has been consistent over the last few years since the ecosystem got going. It just got papered over because lots of people were accelerating from raising 7 to raising 40. So you jumped over that bit. Well, in any normal market, you trip over it, don't jump over it. And that's the issue if we telescope it down, and that is a yawning gap in the market, and probably will be if the market even comes back to normal.
It's mirrored across both debt and equity. It's not just an equity point, it's a debt problem as well.
Yeah. So we are almost out of time, but just to close the panel, I would like to ask each panelist to give their quick comments on if they had $100 million to invest in Africa, where would you put it? And I will start with Victor and then we'll move along. Thank you.
No.
Thanks, Victor.
You're allowed to pass.
One thing, I would probably set up a business that could efficiently finance SMEs across multiple markets. The market's so broken, and there's a lot of worthy SMEs that just don't get a look in from banks.
I'd put my money where my mouth is, and I'd go after the middle market. I think you can take businesses that are profitable and successful and accelerate that growth.
I think to sort of go full circle to how you started us off this morning, I think our hypothesis is that it's these blended capital vehicles that will help us fill that valley of death.
I will go with Victor. I'll go with you. Let's sign a deal. No, I'll definitely go to the SMEs, and to be fair, I would look into the blended structure, which I think that's where it lies, where you can provide that to these companies, but you can also provide the technical assistance, you can provide the training, you can provide the venture building even. So that's probably the route I would take.
Thank you.
So first, we're fundraising, if anyone is interested. But just to say that not in this fund, in the next, and I think if I had the ability to do it today, I would do it today. There is pretty much in every business model on the continent, part of the business model, I say not every, but 7, 8 out of 10, you're selling money as part of your business offering. You're not a fintech, but there is a financing of working capital for someone on the chain. This is extremely hard to come by in local currency. And if we can start solving for that with debt, with other local products, I think that would be extremely useful to unlock a lot of things for many of us.
Michael?
We're talking about an investment. I would invest currently in this dislocated market in Africa's hard currency corporate bonds, which at the moment yield between 12 and 15% in dollars. And I think these are great corporates with very, very low default risk. So.
Great. Well, thank you. Thanks to our audience and thanks to our distinguished panel. Please join me in giving everyone a round of applause. Thank you. And I'm sorry we didn't have time for questions, but if you do want to come and find us outside, please feel free to come and grab us. Thank you.
Exactly.